This is Quent Bilo with an additional discussion of statement of cash flows. In this talk, we're looking at the investing and financing sections of the cash flow report, and also looking at a definition of free cash flow. Again, what do businesses do? They get money, they buy assets, they run the business. We previously covered the operating section, which is running the business, in a previous talk. In this talk, we'll look at getting money and buying assets. Buying assets is investing in productive assets when they're bought, or divesting if they're sold. Getting money is longer-term financing decision activities. The source of these items are other parts of the balance sheet, not the income statement. Again, most of the source of information for the cash flow statement is the balance sheet. For investing, it's long-lived assets, and for financing, it's non-current liabilities and stockholders' equity. So preparing the statement of cash flows primarily uses the balance sheet, and for these investing and financing sections, additional information, not the income statement. So in the investing section, changes in property, plant, and equipment and long-term assets. And financing, changes in long-term liabilities and certain stockholders' equity items. Here's the two sections of the cash flow report itself, the investing activities section and the financing activities section. Again, all three sections will explain the total change in cash during a period of time. So starting with the investing activities section, it's all about changes to long-term assets, productive assets of the business, property, plant, and equipment, or other long-term investments. We're looking at additions that use cash or disposing of long-term assets that can supply cash to the company. The investing activities section answers these questions. How much cash was spent to replace or improve productive assets, such as property, plant, and equipment, or other long-term investments? Or was cash obtained for selling off some productive assets? A positive cash flow on the cash flow statement. We'll commonly see both plus and minuses within this section. Cash coming in, cash going out. Individual line items. So let's start with our balance sheet. We're looking at the long-term assets. So we have property, plant, and equipment here. This particular example does not show any long-term investments. Again, comparative balance sheets, 2013 and of 2014. And we're working with the change column. It's the change column numbers that will appear on our cash flow statement itself. All other assets other than current assets for the investing section. So we'll examine each change to non-current assets. Again, land, building equipment, and other investments. We're looking for increases to non-current productive assets, which are uses of cash as they are acquired, or we're looking for decreases to non-current productive assets, which are sources of cash as they are sold. The gross proceeds of those sales. I want to alert, the property, plant, and equipment section of the balance sheet contains a normal decrease in the utility of these assets. We're talking about the accumulated depreciation contra account, which comes from our current year depreciation expense provision. This has already been accounted for in the operating section. There's no cash flow impact here. Just want to comment that everything in the balance sheet is accounted for in doing a cash flow statement. Every line. So the format of the investing section, again, changes in investments and long-term assets. Cash flows typically come from the sale of property, plant, and equipment, or from the sale of investments in debt or equity securities of other entities that are held by the company, or could come from a collection of principal on loans to other entities. Cash outflows in this investment section, purchasing property, plant, and equipment, purchasing long-term investments, or making loans to other entities. In preparing the investing section of the cash flow statement, we must first take a step back and analyze the property, plant, and equipment section. It's important to completely analyze or unravel the period's activity of property, plant, and equipment. In other words, separate out all actions. Why? Well, to fit the pieces back together again in the cash flow statement to ensure that we're accounting for everything. For example, depreciation decreases in the property, plant, and equipment area are an add back to income in the operating section. There's no cash flow in that journal entry for depreciation expense, and so it's added back to the operating section to nullify the deduct in net income. Any sold property, plant, and equipment assets, the gross amount is a cash inflow in the investing section. And if we purchased or bought any property, plant, and equipment, they're shown as a cash flow in the investing section. Likewise for all long-term assets. These are not part of the property, plant, and equipment, but we may buy or sell these, generating cash inflows or outflows, respectively. There's usually additional data needed for a cash flow statement besides the balance sheet and income statement. This would be typical additional information needed for the preparation of the cash flow statement. So we're looking at the investing and financing areas. Both of these areas, there's no difference whatsoever in the specific formats, whether we're using indirect method or direct method. In this course, I'm teaching the indirect method, so the format of these two sections, investing and financing, are identical irrespective of the method used. Again, looking at our property, plant, and equipment area, which is part of our long-term assets, we'll go line by line and see how it plays out on the cash flow statement. We'll also consult the additional information to piece this together. Items in red and blue here are the relevant additional information for the investing area that we're looking at now. Let's first take our issuing $110,000 of long-term bonds in direct exchange for land. In other words, land increased, we acquired land not by buying it with cash, but by issuing long-term bonds. I call this a crossover transaction between two sections of the cash flow report, the investing section and the financing section. Let's see how it looks for the land side in the investing section, a long-term asset. You see that land increased by $110,000, $20,000 beginning balance, ending balance $130,000. That land went up not because we paid cash for it, but because we issued bonds. Looking at a T account, we see our land goes up by its acquisition by issuing bonds, and our bonds payable goes up in payment of that land. Payment by issuing bonds, not by cash. We're concerned about the increase in land. Now, since this is an acquisition of a long-term asset without using cash, the numbers do not appear within the body of the cash flow statement itself, which only has cash flows, logically. However, we're going to footnote this at the bottom of the statement. At the bottom, we see a disclosure, a footnote disclosure, issuance of bonds to purchase land, $110,000. Footnoted, not part of the actual cash movements during the period of time. This is a requirement that any significant non-cash acquisitions appear in a footnote to the statement. Our next line, buildings, beginning balance $40,000, ending balance $160,000, a change of $120,000 increase. Let's analyze that. We saw that the company acquired an office building for $120,000 cash, straight out purchase. That's what increased the building account. Now, for the use of cash, so in our cash flow statement, in the investing section, we'll have a purchase of a building, negative $120,000, a use of cash during the period to acquire that building. Equipment, beginning balance $10,000, ending balance $27,000, a $17,000 increase. Let's analyze that increase in equipment account. Now, there is some additional information about the equipment account. It increased as a result of two transactions. One, the purchase of equipment for $25,000 cash, and secondly, we sold equipment that had an original cost of $8,000. We sold it for $4,000 gross proceeds. Let's look at the journal entry at the bottom that analyzes this transaction. So we sold the equipment for $4,000, debit or increased cash for that amount. We must remove the original book value of equipment, $8,000 credit to the equipment account. We must remove the associated accumulated depreciation of $1,000, which is given separately in our footnote. That generated the loss on disposal of $3,000. In effect, a net book value of $7,000 was sold for $4,000 cash, generating that $3,000 loss on disposal. That loss on disposal is part of the operating section. We're just dealing with the investing section. Now, in our additional data, we were told that both we sold equipment for that originally cost $8,000 and we purchased equipment for $25,000. If we were only given one of these elements, for instance, the sold equipment for $8,000, we could have backed into the purchase of $25,000, knowing that our beginning balance was 10, ending balance was 27. We could have backed into that $25,000 purchase had we not been given that amount. Let's see how this is reflected on the cash flow statement. So we had two cash flows in that transaction where we sold cash. An outflow for the purchase of new equipment and an inflow for the sale of equipment. Gross amount sold, $4,000. We mentioned we previously added back the loss on sale in the operating section as an offset. Why? Because that loss reduced net income, but there was no cash impact, so that add back of the loss nullified the impact of the income statement. Here's our reflection on the investing section for the purchase of equipment, $25,000, use of cash, negative number. The sale of equipment, the gross proceeds, $4,000, positive in the investing section. This recaps our previous treatment of the loss on disposal. It was an add back to the operating section. Why? Because the $145,000 in income was reduced for the loss, but in that line, there was no cash in that line, so we offset it with the add back of loss on disposal of equipment to nullify that effect in the operating section. This concludes all the items in long-term assets. And so our net cash used by investing activities is a negative $141,000, simply the sum of the three entries between purchase of building, purchase of equipment, and sale of equipment. Review question. Which is an example of a cash flow from an investing activity? C. Receipt of cash from the sale of equipment. Equipment is the only long-term asset above, reflected in the investing section. All other transactions, bonds payable, repurchase of capital stock, or payment of cash to suppliers for inventory, those are in different sections of the cash flow report, not the investing section. Let's summarize the rule changes reflected in the investing activity section. Again, we're examining each change to long-lived assets, property, plant, and equipment, or other long-term investments. LTA, abbreviation for long-term assets, are reporting rules. We report long-term asset increases as cash reductions or purchases to acquire those assets. We report long-term asset decreases as cash sources as we have sold those assets. And as mentioned, the depreciation deduction, accumulated depreciation in this area is a non-cash event. It's handled in the operating expense offset reduction area, not in the investing section. Why? Because depreciation expense affects operations. We should remember that it's useful to T-account all changes to a long-term asset account if there are both sales and purchases during the same period. Sales come out at their original cost. Looking at the T account, I want to emphasize that the equipment sold comes out at the original cost. It's also useful to reconcile changes in accumulated depreciation. We had a beginning balance of $6,000. Our current year depreciation provision was $9,000. We saw that either in the income statement or additional data. And then the equipment we sold, we have to remove the accumulated depreciation associated with that equipment, given at $1,000. That reconciles to our ending balance in accumulated depreciation of $14,000. The net book value of the equipment sold was $7,000. That is the original cost less associated accumulated depreciation of $1,000. The footnote at the bottom shows our journal entry for depreciation expense during the time period. The final section of the cash flow report is the financing section. Here we're concerned with the remainder of the balance sheet changes, that is long-term liabilities and other equity changes except net income, which was reflected in the operating section. So financing is about getting money. Remember, this business activity generally starts out a new venture, a need for money, but there can be additional needs for new infusion of cash if a company is expanding rapidly later. There can be repetitive actions such as paying dividends, a use of cash, or redeeming bonds, buying bonds back using cash. All these activities are reflected in the financing section of the cash flow statement. Here's a look at the balance sheet. Long-term liabilities, we have bonds payable, and we have common stock and retained earnings, part of stockholders' equity. As mentioned previously, we will not include changes to retained earnings that involve net income, since that was taken into account in the operating activities section. So LTL, long-term liabilities, and certain equity changes reflected in the financing section of the cash flow statement. What type of activities do we track in financing? Cash inflows from the sale of common stock or inflows from the issuance of debt. Cash outflows, payments to stockholders as dividends, or redeeming long-term debt or reacquiring capital stock, known as treasury stock. The financing activities section answers these questions. How much cash was spent to pay dividends or redeem or retire bonds or purchase treasury stock? All these are negative cash outflows on the statement. Or how much cash was obtained for selling and issuing stock or bonds or selling off existing treasury shares? All positive cash flows on the cash flow statement. Again, we can see various activities, both plus and minus, within this section. So let's start off with long-term liabilities. Our bonds payable account, beginning balance $20,000, ending balance $130,000. That $110,000 increase was previously accounted for as a footnote in the investing section. There's no cash occurring here with the issuance of bonds. We acquired land with it, not cash. Therefore, it's not going to be in the body of the cash flow statement. We already handled that. Let's turn our attention to the common stock line and retained earnings. The additional information indicated that we sold common stock for $20,000. That accounts for the increase from $50,000 to an ending balance of $70,000. $20,000 increase in cash. It's useful also to reconcile the retained earnings account, which I've done at the bottom here. Beginning balance $48,000. What increases it? Net income, $145,000, accounted for in the operating section, less cash dividends, coming down to an ending balance of $164,000 in retained earnings. Again, in the common stock account, it's increased entirely due to the sale of shares. The opposite entry is the debit to cash, increase in cash, and therefore reportable in the cash flow statement in the financing section. So in financing section, issuance of common stock plus $20,000 for the sale of stock. Back to the retained earnings account analysis, we see dividends paid of $29,000, debiting retained earnings, crediting cash, a cash outflow. On the statement itself, we see the payment of cash dividends, negative $29,000, cash going out. That concludes the financing section of the cash flow statement. It all adds up to net outflow of $9,000. Let's summarize the rules reflecting changes in the financing activities section. Again, we're examining all changes to long-term liabilities and the remainder of equity beyond net income. So non-current liabilities, bonds payable, notes payable, etc. The LTL long-term liability rules report long-term liability increases as cash sources, report long-term liability decreases as cash uses for redeeming or retiring bonds payable. In the stockholders' equity section, we report stock increases as a cash flow increase due to the sale of stock. We report stock decreases as a use of cash, such as acquiring treasury stock. In retained earnings, we're reporting dividends paid as decreases, cash uses, and the net income effect is already taken care of in the operating section, not in the financing section. This chart just recaps our analysis of the T accounts at the bottom of the page. Our buildings, accumulated depreciation buildings, equipment, accumulated depreciation equipment, and land, all our long-term assets, as well as our bonds payable, long-term liability, common stock, and the remaining part of the retained earnings of the dividends. We see that we have a net $141,000 of cash used by investing activities due to the purchase of equipment, the purchase of building, partially offset by the sale of equipment, and financing has a net So as we prepare the statement of cash flow, we should do a check at the end of the statement. We should compare the net change in cash on the statement of cash flow that we developed with the change in cash on the balance sheet to make certain that the amounts agree. That's what we're trying to account for, is the change in cash on the balance sheet from period to period. Have we accounted for it in the three sections on the statement of cash flow? In other words, has the change in cash, in this case a $22,000 increase during the year 2014, been accounted for properly on the cash flow statement? And we see that it has. Net increase in cash, $22,000, which is the summary of the operating activity section, the investing activity section, and the financing activity section. These three must add up to the change in cash on the balance sheet. If it doesn't, an error was made and it has to be retracted and spoked out. The last few lines are arithmetic only, taking that change in cash, adding the beginning balance of cash, developing the ending cash of $55,000 on the year-end 2014 balance sheet. A brief recap of all three sections of the cash flow statement. We previously looked at the operating activities section, which starts with net income. Any expense or revenue item that ends up in the net income statement is taken care of in that section. Any buying or selling of current assets, all changes in working capital, that is, current assets, current liabilities, are reflected in that section. We just looked at the investing section, longer-term investments, capital expenditures, buying of property, plant, and equipment, also their selling or any other investments or loans made to other companies. And finally, the financing activities section, obtaining cash from the sale of stock or bonds, or use of cash in retiring and redeeming bonds, use of cash in paying cash dividends, or use of cash in buying treasury shares, or obtaining cash by selling treasury shares. A final comment on significant non-cash changes that changed our balance sheet. We purchased land by issuing bonds, a significant non-cash investing in a financing activity. This must be footnoted. Since it didn't involve cash itself, it's not in the body of the statement, only a footnote. Other examples of significant non-cash activities would be the direct issuance of common stock to purchase assets, again, acquiring a long-term asset without using cash, or converting bonds into common stock, retirement of bonds without using cash. Our example was the issuance of debt to purchase assets. All these activities not involving cash need to be footnoted at the bottom of the cash flow statement. Let's go through a brief exercise that classifies these various transactions. What section of the cash flow statement would they appear in? Issuing 100,000 shares of $5 par value common stock for $800,000 cash. This is a cash source. What section of the report is in? Financing, involving the equity section. Borrowing $200,000, signing a 5-year note, 8% interest. It's a cash source. What section of the cash flow statement? Again, financing, long-term liability. Number 3, purchasing semi-trailer trucks for $170,000 cash. It's a cash use. We're acquiring a productive asset. It's in the investing section. The investing section is all long-term assets. Purchasing a long-term investment in the stock of another company, a use of cash, also in the investing section, a long-term asset. Selling off equipment for $4,000, that's no longer needed. This is a source of cash. It appears in the investing section because we are selling off a long-term asset. The chapter defines a term called free cash flow. Let's look at that definition. First, it might be better described as a leftover cash flow generated from operations, left over after a couple of events. Here's the definition of free cash flow. We start with the total net cash provided by operating activities, the total section. We deduct any capital expenditures, additions to property, plant, and equipment. We deduct any cash dividends paid during the period. So free cash flow describes the cash remaining from operations after adjustments for capital expenditures and dividends. Both of these activities, capital expenditures and cash dividends, are considered necessary for the operation of the business. Capital expenditures to keep property, plant, and equipment replaced as it wears out, and cash dividends because stockholders expect some return on their investment. So beyond accounting for that, the rest of the cash flow from operations is termed free cash flow to be used for other purposes as deemed by management. Let's look at an example of free cash flow. Use a Microsoft statement of cash flow. Cash provided by operations, $26,994. These are likely in millions of dollars. Let's calculate free cash flow for Microsoft for this year. Starting number, total cash provided by operations, $26,994. Let's look for our capital spending. That's our additions to property, plant, and equipment. $23,555. We're going to deduct that from $26,994, and also dividends paid at the bottom, $51.80. That nets down to $19,459. So $19,459 is the free cash flow, remaining cash flow from operations after deductions for capital spending and cash dividends paid. Leftover cash flow.